I've had various conversations with friends, colleagues, counterparts, and there's this weird undercurrent of nervousness in both directions. People not really knowing what to make of the market. Um, Long-term market participants have sort of commented that just things seem weirdly unsustainable. Valuations are high. The negative yielding debt in Europe just continues to pile on, which is causing all sorts of distortions in the marketplace. And there's this general feeling of nervousness, malaise. It's not really clear, but yet they look at the performance of the broader indices, and the stock market hangs in there. We're still within spitting distance of new all-time highs. What gives? And in thinking this through, I'm thinking about a little bit of a change in strategy that may be applicable to various investors. About a month or two ago, someone at thestreet.com doing an interview said, "Is it crazy for people who want to go to all cash?" And I said, "Not necessarily, because because basically, if you're nervous about the market, there's not a ton of movement on the upside. Cash is, even with the Fed rate cuts, has been yielding something reasonable. So you can get paid to sit on the sidelines. But then on the flip side, a lot of these, some of the people have said, yeah, but the fact that the market doesn't sell off means that we could be susceptible to a blow off top. And that's not an unreasonable fear. I mean, that folds back into the fear of missing out if there's the potential for a big market rally. You don't want to be out of the market necessarily if you think that there's a real possibility of that. So what structure might work? And what occurs to me is if you're one of the people who has been raising cash, it might be appropriate to hedge your cash with call options. What that would allow you to do is basically essentially be out of the market, but allow you to buy insurance against underperformance. So you would set up a structure where if you've got a lot of cash, but you think that a particular sector, a particular stock, or the market as a whole might be susceptible to a rally that sneaks up on you unexpectedly, that's when you would want to be basically hedging your cash position with long calls to give you the exposure to the market just in case. And I'm doing this now when with the VIX, let's say in 14, 15 range. That's where it's kind of more appropriate. Let's say VIX levels. I'm just using this as a very broad term because I'm oversimplifying. But let's say with the VIX 15 or lower, it's really not very expensive to buy the calls. We've seen a bit of a skew right now, even more than normal, with people buying puts, pushing up the skew, the implied volatility on out-of-the-money puts, let's say, versus out-of-the-money calls. So they're not expensive necessarily. Now, buying a call is a wasting asset. Just as you would if you're long a portfolio and buy puts to hedge, you think of this as buying insurance, except in this case, you're buying insurance to hedge against underperformance rather than an absolute decline. In this case, if you're raising cash, you're relatively insulated from a decline, but you would participate in the upside. There's a lot more to go on in this one. I'm just throwing that out there for people who have been raising cash based on the general misgivings that they're seeing in the marketplace, but would be fearful that something else could push the market higher, trade resolution, et cetera. And this would be your way to hedge against that. It's a little bit of an upside down trade, but it might be effective depending on your circumstances.